It's another week here at the Dukascopy TV Centre, and we're joined once again by our resident financial expert, Dr. Frank Hollenbeck, who's here today to discuss with us gold standard prices. Welcome back into the studio. So gold standard has become politically relevant again through Newt Gingrich, the US presidential candidate, who has pledged to appoint 2 new advisors to a new commission, the Gold Commission, that would explore the feasibility of returning the US to the gold standard. Now, economists were asked this question: if the US replaced its discretionary monetary policy regime with a gold standard, defining a dollar as a specific number of ounces of gold, the price stability and employment outcomes would be better for the average American. And this is how economists responded. Now, as we can see here, the opinion's pretty unanimous there. They don't agree with this. Why is that?
Well, I like what the question said. It said price stability. To a large degree, I think a lot of these economists are what I would call ivory tower economists, somewhat what I would consider to be detached from reality. Let's say that the proof of the pudding is in the eating, in the sense that money has 3 functions. Its primary function is as a medium of exchange. The second function is a unit of account. And the third function is a store of value. Now, for the first 2 functions, money just naturally occurs. For example, we've had in the World War II, in the prison camps, we had cigarettes were money. And in South Pacific Islands, we had seashells were used as money. So in other words, we didn't need a government to define what money was. It occurred naturally to avoid what we call the double coincidence of want, in the sense that you have what I want and I have what you want, and then we can exchange. The money allows us to avoid that double coincidence of want. Now, let's look at money as a store of value. If we look at the gold standard, and of course it's not perfect. For example, we had the California gold rush. But if we look at a dollar, what you could purchase for $1 in 1800, you could basically purchase the same thing in 1900. In other words, it kept its store of value function. Now, if we look at a dollar since the inception of the U.S. Federal Reserve System in 1913, the dollar has lost nearly 98% of its value. Okay, so when we talk about dollar as a function of a store of value, I would say that the gold standard has done much, much better than the current system that we have in place. We have to remember that the government can tax you 3 different ways. Okay, it can tax you directly. That's called the income tax. It can tax you in the future. That's by borrowing, and in the sense that if it borrows today, basically it has to be paid with taxes in the future. Or it can tax what we call your cash balances, or it can tax the money in your pocket. Let me give you a very simple example. Suppose that you have 10 apples and you have $10. Now, the price of the apples will be $1. Okay, it can't be $2 because then we'd have people with apples that couldn't sell them and they'd reduce the price. It can't be 50 cents because then we'd have people with money who can purchase apples. So the price of an apple will be $1 for 10 apples, $10, 10 apples. Now, suppose that the government comes in and it prints $10. Okay, and it competes with the private sector for the apples. So what will happen is that we have $20 chasing 10 apples. So the price of the apples will go to $2 per apple. Okay, now what has happened? Okay, the public has $10. At $2, it can only purchase 5 apples, and the government's been able to purchase 5 apples. So by printing money, what the government has done is been able to take real goods and services away from you. It's been able to take 5 apples away from you by basically taxing the cash in your pockets. Okay? If we look at African governments, we'll see that a lot of them have relatively high inflation rates. And the perfect example is Zimbabwe, that has hyperinflation. The reason African countries have a lot of inflation is that those countries can only really tax you the third way, in the sense that most of the economy is black market, so it's very difficult to tax you directly with an income tax. The African governments can't really go in and borrow a lot of money on the capital markets. So the only way they can pay for their militia, for their military, military is essentially to print money or to reduce the value of the money in your pocket. So what we're saying is that the thing is about the current system that we have is that we basically have destroyed to a large degree the store value of money as the value of money as a store of value. These economists believe that the central bank is independent and they don't want the money supply to be determined by gold production in South Africa or gold production in China. They believe that the central bank is independent and therefore the central banks can determine the amount of money into the system, and they supposedly will determine the optimum amount of money into the system. The problem is that they believe that central banks are independent. It's a bit like the socialists believing in a government benevolent dictator who will dish out social justice. The sense is that central banks are not independent, and that's very, very clear. If they were independent, the ECB wouldn't be purchasing government debt. If they were independent, the US central bank would not have bailed out the banks in 2008. If the central banks were independent, we wouldn't have the Swiss central bank basically subsidizing exporters at the expense of everyone else in Switzerland, because it's having an impact on the value of money. And the important thing to realize is that look what happened in 2001. In 2001, the US central bank tried to avoid a recession, and they kept interest rates artificially low, and the money supply increased significantly. And it was the unintended consequences of the actions that led to the housing bubble and to the crash of 2008. And I'm afraid the same thing is happening now in Switzerland, is that to basically help exporters, they don't really understand the unintended consequences of their actions. And we may be seeing some of it in the increase in housing prices in Switzerland and the fear of a housing bubble here in Switzerland. What I'm basically saying is that the best laid plans of mice and men, and this may be a problem in terms of having the central banks run our monetary policy.
You said there about the dollar losing 98% of its value, and here we can have a look at central banks' total assets, and we can see sort of the increase. Can we expect, therefore, similar losses?
Absolutely. I think it's lost 98% of its value since 1913. With this type of monetary growth, you can expect it to lose a lot more value. You have to understand is that when we add up all the central banks, okay, in actually 2008, we had a total amount of money in the system which was about $4 trillion. Since 2008, we've gone from $4 trillion to $15 trillion. Okay? It took us 100 years to go to $4 trillion. In the last 4 years, we've gone from $4 trillion to $15 trillion. So yes, you can expect the value of money to decline significantly.
One of the economists, in answer to the survey, replied, why tie it into gold? Why not 1982 Bordeaux? And he does have a point. Why gold specifically?
One of the reasons everybody is going into gold, or why gold prices are going up, is in a hyperinflation environment, you always want to be in real assets. The experience over 50 examples of hyperinflation is that the people who make out are the ones who take their assets and put their money into real assets. That's why you're seeing gold going up. You're not seeing housing going up because it was in a bubble and we had overconstruction of housing. But what you're seeing is any other real assets, whether it be gold, antiques, stamps, everything else is actually going up in value. Well, I think if you remember from one of my previous interviews, I said it could be Martian poop pellets for all I cared. And the reason is that we have to have something that the government can't control, or that the government can increase at its own will. When you look at these numbers, you kind of wonder what country in the world hasn't printed excessive amount of money. Newt Gingrich talked about creating a colony on the moon. Maybe we can establish money as a solid store of value on such a colony.
Gold prices have already increased by 10% just this year, and that forms part of a 10-year uptrend. If gold standard were to be introduced, what impact would that have on the price of gold?
Well, a lot of people say that we couldn't go back to the gold standard because we don't have enough gold relative to the amount of money that we've produced. I want to go back and give you an example that happened in the 1920s after the German hyperinflation. It actually went back to the gold standard. It went back to the old currency that they had before World War I. And it went back to the gold standard with almost no gold. And you're probably going to say, well, how could they go back to the gold standard without any gold? And the reason they were able to go back to the gold standard is that they basically said, we're not going to print any more money. Okay? And because they said, we're not going to print any more money, people found that the metal marks they were using had a store value. So they weren't necessarily wanting to convert it into gold, and they used it as money. So that was the key to going back to the gold standard, was just ensuring that you didn't print any more money. So we could go back to the gold standard just by making a statement. Okay? That would be relatively easy to do.
Dr. Frank, thank you very much. Dr. Frank will be back with us next week exploring another financial topic. For now though, goodbye.